course, there's ups and downs.
Ups and downs. I'm curious about a down right now. Talking about passions, do you have a passion for credit card debt?
And I would sit down with people and show them how to get out of debt. And they would go home and promptly not do it.
If you're in debt and you do have a little bit of extra money to send, you're going to call your student loan provider, your credit card provider, your mortgage provider, and you're going to ask them, how do I contribute to the principal of this debt?
And when it comes to tackling debt, there is a lot of noise when it comes to choosing how to pay it off. If you listen to the likes of Dave Ramsey, then you've probably heard of the debt snowball method, where you pay off your smallest debts first and work your way up to your largest debt. Or you may have heard of the Avalanche Method, which prioritizes paying off the debt with the highest interest rate. But is there a right choice when it comes to paying off debt? This is Rich Girl's Guide, where we demystify the world of personal finance to help you create a financially successful and fulfilling life. I'm your host, Kirby Delicano, and I worked in wealth management for over 6 years before leaving the office to focus on my business and my family. According to Business Insider, quote, the average debt an American owes is $104,215 across mortgage loans, home equity, lines of credit, auto loans, credit card debt, student loan debt, and other debt like personal loans. That is a massive figure. Of course, mortgages are included in this number, which has undoubtedly driven up total debt. And while I personally don't have an issue with having a mortgage, as long as you can afford the monthly payments and your property is going to retain or increase in value, at the end of the day, debt is debt. If you are one of the 77% of Americans that have debt and you want to know how to pay it off, please, for the love of holy guacamole, watch this episode in its entirety. We're going to outline the different methods you can use, the pros and cons of each method, and at the end, I will let you know how I would go about tackling debt if I were in your shoes. Let's start with the snowball method. This method states that you should pay off your smallest debt first, then your next smallest, and so on and so forth, essentially creating a snowball effect. Let's run through a quick example. Matilda has a total debt of $10,000 spread across 3 credit cards. Card 1 has a balance of $500, Card 2 has a balance of $3,500, and Card 3 has a balance of $6,000. Card 1 has a minimum monthly payment of $50, Card 2 has a minimum monthly payment of $200, and Card 3 has a minimum monthly payment of $350. Let's say Matilda gets a second job and is able to put $1,000 a month towards this debt. According to the snowball method, no matter what the interest rates are, the first credit card we are going to pay off is the smallest one, the $500 card. She will pay the minimum monthly amounts on all 3 cards, which totals $600, and the extra $400 will go towards paying off her smallest credit card. Matilda will still have a small balance of $50 on her smallest card, and she will owe a bit more due to interest. Let's call it $10. The next month, she will pay off that small card completely, which totaled $60, $50 balance plus the $10 interest, so that she now only has 2 cards to pay off. She will pay the minimum monthly amounts on the remaining 2 cards, totaling $550, which leaves her with $390 to spare, and she's going to throw that entire amount onto her next smallest card. This will continue until all debts have been paid off. And real quick, I wanted to pop in and say thank you for listening to today's episode. If you haven't already, please consider popping over to YouTube and hitting that subscribe button. We are so close to 200 subscribers, which helps the show reach more listeners like you. All right, let's get back to the show. Pros. The biggest pro to the snowball method is that you will start paying off small debts in a relatively short period of time, which creates small wins early on in your debt-free journey. Proponents of this method argue that people are more likely to continue paying off debt if they have these small wins early on, and the momentum will continue to build as the number of debts go down. Cons, on the other hand, people who dislike this method bring up the fact that after you pay off the smaller debts and get to the larger debts, you may realize it is going to take a lot longer to pay them off, and you might get discouraged. If you get too discouraged, you may decide to just give up entirely. The biggest con to me, however, is the fact that this method does not take interest rates into account. Speaking of interest rates, let's discuss our next debt payoff method, the Avalanche Method. Now, the Avalanche Method not only takes interest rates into account, but it actually prioritizes your debt based on the interest rate alone. Let's use our friend Matilda as an example again. Card 1 has a balance of $500 and an interest rate of 12%. Card 2 has a balance of $3,500 and an interest rate of 21%. And card 3 has a balance of $6,000 and an interest rate of 29%. The Avalanche Method would dictate that card 3 with the 29% interest rate would need to be tackled first. Card 2 with the 21% interest rate would be next, and finally card 1 with the smallest interest rate of 12% would be paid off last. The obvious pro is that you will pay less interest using this method, which in turn means you will pay off all of your debt in a shorter period of time. Now, the total interest saved and shorter time period will obviously fluctuate depending on your situation, but when it comes to paying off debt, you do not want to leave any extra money on the table. If you are strictly looking at the numbers, the Avalanche Method is usually the way to go. Cons. So the cons to the Avalanche Method is kind of the opposite to the pro of the Snowball Method. You very well may be paying off your largest balance first, which in turn could lead to fatigue, since it will take longer to receive your first win of paying off a small debt. I think the biggest factor here is knowing your personality. If you know you are going to need a little nudge, a small win at the beginning of your debt journey, you may not want to go for this method. Let's talk about debt consolidation. This method essentially says that you will take all of your smaller debts and combine them into one large debt. Typically, this is done by getting a personal loan from a bank or lender for the total amount of debt that you owe, and then taking that money to pay off all of your other debts. You are left with one larger loan, hopefully at a lower interest rate than your smaller debts, and you can then work on paying off that one debt. Pros. The obvious pro here is that everything is consolidated into one debt, which means you only have to worry about one monthly payment instead of a bunch of smaller ones that may fall on different days of the month. You can also negotiate to have a better interest rate than your credit card that might be in the high 20s. For example, PNC is currently offering personal loans at a rate as low as 7.49%. Of course, that rate is going to depend on your income and your credit score. So if you find yourself in the predicament of needing to consolidate, you will likely have a higher rate than whatever that low rate they advertise. Cons. This can sometimes lead people into accumulating more debt because they have a feeling of accomplishment from consolidating the smaller debts, even though they still have the same amount of debt that they started with. This will also lead to one large minimum monthly payment, which is fine unless you accidentally miss a payment or are unable to pay for some reason. So what is the best method to pay off debt? Personally, I think that if you take a little piece from each of these methods, you can craft your own personalized payoff method that will be perfect for you. Write down each of your debts on a note card and make sure you have 3 figures: balance, interest rate, and minimum monthly payments. If you have any debts that are outrageously small, like let's say anything under $200, regardless of the interest rate, you should go ahead and pay those off first. Get rid of them so you don't have to waste your time or energy thinking about them. And as you pay them off, you can even burn that card in the fire or throw it in the trash if your little heart desires. Now you can organize the rest of your debts based on their interest rates. The highest rate should be paid off first, and then the next highest rate, etc. Important note here, while you are organizing your debts, let's say you come across one that is $3,000 with a 20% interest rate, and you have another debt that is only $300, but it has a 19% interest rate. We can use our deductive reasoning to say, hey, the interest rates are close enough that I would rather pay off the $300 one first to wipe it out and then immediately move on to the $3,000 debt. And while we're organizing the order of which we will pay off our debts, we might actually see that some of our debt has smaller interest rates in the 10 to 15% range, while another portion has higher rates, maybe in the 25 to 30% range. If you are so inclined, you may want to shop around and see if you can consolidate the debts with the higher rates into one larger debt, leaving you with less debts to organize and paying less in interest over time. All right, guys, have you tried any of these methods before? If you did, how did it work out for you? Let me know, drop a comment below, or submit anonymously through the link in the description. Don't forget to subscribe or follow wherever you are listening right now. And as always, I will have a video out this Thursday on YouTube and a brand new episode next Monday. Lay the rich, girls.